What is up, everybody? Welcome to another episode of Philosophical Friday. This is your hosts, Duncan Palamordas and Peter Birmingham. Once again, you're here with us, Peter. Welcome, 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 like Brad would say. How's
Yeah,
everything
thanks
good,
very
sir?
much, Duncan. Yeah, delighted to be back again and have a chance to discuss another interesting topic. Hopefully, we can delve into our chosen subject for this week.
Excellent, excellent, excellent. And again, I mean, Brad has been very busy lately, so we're doing this for the foreseeable future. Excuse me, if I understand this correctly. And so, what's today on the agenda, Peter? What are we going to talk about today?
So today we are going to discuss based off a website called longbets.org.
Hmm.
And this is a site, and it's a pretty old site, and like I mean, you can kind of readily tell that this is I think you mentioned it was originally from the early 2000s,
Right.
and this is where people come together and they make long extended bets on
Hmm.
events that they expect will happen, and there's somebody takes a contrarian position. I think most of the people, if you dig into the people who are making it, most of them are kind of writers and
Hmm.
experts in the area. That so yeah, so that's basically the premise of the website.
Absolutely. And there are people, from all different areas. There's a lot of scientists, a lot of philosophers, a lot of writers, like you said, a lot of people who belong in think tanks. And basically, they're trying to raise awareness on some issues. Like those issues can range anywhere from down to earth things like politics, all the way to environment, philosophy, technology, sports, you name it. And they make predictions which are typically really long term. And by really long term, we mean anywhere between the next couple of years, which is incredibly short term for those standards, all the way to 50 years, 100 years ahead. And
Yeah.
we're going to talk a little bit about that, about the viability of this. We're going to talk a little bit about the structure of how it is structured. We're going to talk a little bit about the way they're pricing things, because these are not professional gamblers, as you can imagine. So some of you people, looking to maximize EV over there, we know we were having this conversation before they started. We're like that
Yeah,
too. But
this is not the website for you for Max TV. This
it's
is
not
definitely more along the lines of a gentleman's bet.
gentleman's bet,
Um,
exactly. So why don't we start there? Why don't we talk a little bit about structure and why exactly it's not the proper way to make, let's call them profitable bets. Let's start from there.
yeah, so I suppose like that they take a subject, as you say, they're looking to raise awareness on it. You've got one person who's pro and one person who's con, and they have like their stated position. Like one that stands out. No Republican president will be president. No Republican will be president of the USA before on December 31st, 2039.
Right.
Before that date, so that's a pretty straightforward structure, and the
Right.
terms of that bet are very very simple.
Right.
But for more complex bets, then the terms get a little bit, they trash out the terms. If there's figures involved, they have named a particular data set that they're going to operate off. And that's how they structure it and lay it out.
That's exactly correct. And we should also note that they do not offer odds, right? So usually all of these bets are 1-to-1. Either a certain event is going to happen or not. Typically, I mean, you can say that they're sort of like adjusting those odds indirectly by extending the period of time. One comment that I want to make, because these are incredibly long-term bets, I could not find anywhere in the website mentioning whether or not, if somebody loses the bet, whether they have to pay right away or they should pay when the duration mentioned in the bet is mentioned. Let me give you an example for that, right? Let's say that we're talking about a bet that says that in a 50 years, in less than 50 years, let's say we're going to have completely more than, let's say, 5 million, five million self-driving cars, right? Which, by the way, we're getting very close to this already. But
Yeah.
let's say that within 50 years. So here's the thing: whether or not you believe this is true or false, you're sort of free rolling if you always take the positive side of that bet, right? Because here's the thing: if the bet is like 50 or 60 years in the future, the bet technically tells you that you lost only after the 50, 60 years end, and the thing that you bet on didn't happen, right? Whereas if it does happen, you get paid right away, right? So that's one thing that, you know, if you're a professional gambler, these are sort of loopholes that you see immediately. So you make a ridiculous bet, we're going to have, like, let's say 2 heads by the end of the next century, let's say. I mean, that's a super safe bet to take, because again, you just have to wait, let's say 200 years. We're not going to be alive to, you know, see any of this, let alone pay the other person, you know. So I want to make that clear, that when we're approaching these types of bets, we really are looking them, again, not from the perspective of EV, but rather from the perspective of, you know, do we think this thing is going to happen or not? Because there's some interesting questions. And speaking of interesting questions, because I'm sure the listener wants to hear, what are the questions? What are they asking? Do you know what the first bet was?
The very first bet.
The very first bet, and we didn't plan this because I wanted it to be a surprise, because it's very interesting what the first bet is.
I have no idea. I did not go that far back. I was kind of starting with them. I started when I was looking at this at the more recent ones, because obviously a lot of the earlier ones had been kind of settled at this point.
Absolutely. And the reason why we didn't discuss this earlier, because it's an amazing coincidence. It has to do with our topic last week. So the very first bet was made in 2002. It was for 27 years. And then the short version of it is, by 2029, no computer or machine intelligence, aka artificial intelligence, will have passed the Turing test. And so by 2029, no computer will have passed the Turing test. And for the listener, the Turing test is basically a way to differentiate or not between humans and machine, proposed by Alan Turing in the 50s. And the idea of the Turing test is essentially, behind closed curtains, you interview essentially a bunch of humans and one machine. In what we, even in 2002, they knew as a chat box. So we were sending inquiries, and then we hear back answers. And then it's the job of the interviewer to try and discern which of the answers came from a human and which of the answers came from a machine. And if they can tell, okay, this is a machine answer correctly, then the machine has failed, as we say, the Turing test. And that was made in 2002. So 27 years from 2002 is 2029. So we're nearing the end of it. And the two proponents are Mitchell Kapor and Ray Kurzweil, who, by the way, was the inspiration. Ray Kurzweil is the, I believe, he's the challenger, meaning he's the one who thinks that we will be able to find computers that are going to pass the Turing test. And Peter, I don't know if you know this, because I didn't mention it. He was the inspiration why I created the position that I did in last week's podcast. The idea that we can have bionics perhaps, but we cannot necessarily have Terminators, unless we actually crack the miracle of life.
That's really tied in nicely with last week's topic now, and that's funny. That's a funny coincidence.
That's a very funny coincidence, and I should probably sort of like to close a little bit that point just a little bit. I should point out that Kurzweil has written a lot about technology. He's written a lot about, he's considered to be a futurist writer, right? I mean, he talks about technology and a lot about all of the positives that are happening with technology. And there is, for anybody interested in all of these bets, there are essays of people, or at least a short description of their position, why they think this is going to happen or why they think this is not going to happen. And like I alluded to earlier, Kurzweil was the inspiration of something that I thought it was actually incorrect, right? I mean, I really loved his passion about technology. I really loved his passion about, the future, but I thought he was going a little bit too far on the optimistic side of things. And to be very fair to his argument, by the way, which if you read it, it's a very meticulously and very eloquently described argument. It's probably 10,000 words long. But he's actually making a distinction, Peter. It's incredibly interesting. He's making a distinction with what he calls hardware, and that will be the computational power of the computer, and software, which is what we would call the rules of the game or the initial conditions. I wrote an article also on the Village there, which is essentially the rules of the game. What should computers be allowed to compute on? What direction are they can take, right? Because there's all sorts of different directions. I mean, if you don't teach a computer the rules of chess, they're not going to be able to beat you no matter how quick they are in calculations, right?
Yeah, the initial input has to be there. That's the force. That's almost the spark, the big bang moment where you first started input.
Exactly right. You nailed it. Exactly. Like the Big Bang conditions, or whatever we're going to call them, the initial conditions. And in this case, we're talking about consciousness, perhaps, or we're talking about, a machine that can fake consciousness in some regard, right? So he calls that software, and to his credit, he realizes it's a very big issue and very difficult for humans. I think the part I disagree with him, if you will, is that he thinks that hardware and software sort of like fall in the same category. Just because we can create machines which can be incredibly fast and calculate very quickly, that means we can equally solve the mystery of life. And to me, I draw a distinction between calculations and understanding of what life is. In other words, to put it in a different perspective, it's one thing to say that the velocity of us increases, and it's another thing that we're going to reach at the end points of that trajectory. In other words, yet again, just to simplify that a little bit, because again, it ties so nicely with what we were discussing last week. It's so beautiful. He even talks about Deep Blue, and he even talks about Penrose and whether consciousness is calculational or not, computational or not. It's beautiful. But just one more thing, and I know I'm running on a rant here on a very, very long tangent, and I apologize.
That's okay, Duncan. That's okay. We're here to learn. We're here to hear these news.
So one more thing that I think is just one more way of putting it. It's believable that we can, invent teleportation, so to speak, right? Something completely ridiculous, right? I mean, we can, like you see, I don't know, like in Star Wars, in one of those
Star Trek, yeah,
Star Trek stuff.
Beam me up, Scotty.
Exactly. Like it's conceivable that we can, like calculation can get to that extent. We can perform all of these ridiculous things before we even solve the mystery of life, right? Because who knows how deep that thing is going to, right? And I was inspired by this article because again, it reminds me of meta humility. It reminds me of the gentleman of the 19th century, late 1800s, right? That they said everything that is to be discovered has been discovered already.
Yeah.
And I have, a very hard time believing that there will ever be a moment in history where we will have resolved everything, right? I could be wrong on this, but that's my conjecture, and that's where I disagree with Kurzweil. And he was my inspiration of that disagreement because he's so eloquent, he's so positive, he is always, so excited about technology. And he says, but we can calculate things so well. We come so close understanding the brain, and he's absolutely right. But the question is, can we get to the end of it? Not just can we get faster and faster in revealing information. That is, to me, the big question, because if we are to replicate consciousness, we need to unlock what I would call the soft problem of life, meaning we need to at least know where life starts. Like we may not understand exactly how, but we need to know where it starts. And if you can call that string theory, you can call it something, but we know that we cannot go beyond that. That's the end all be all. That's where life starts. We set it in stone, and that sounds like a ridiculously hard, and I mean ridiculously hard, more than, spontaneous combustion, or like, all of these crazy anything things you can imagine. And that's the end of my tangent, Peter, and I apologize yet again.
No, it's fine. And I suppose, like, I mean, the way I would look at it, and I certainly wouldn't be putting it anyway as eloquently as Duncan has, but I'd look at it from a slightly more simplistic viewpoint, where we're almost talking, and correct me if I'm wrong here, but we're almost talking about the difference between actual intelligence and wisdom on the other side of things. Like, I mean, you can have all the knowledge in the world, and an Irish rugby player once quoted, I'm not sure this is actually his quote, but he said this out loud. He said, "Intelligence is knowing that a tomato is a fruit.
Yeah.
Wisdom is knowing it doesn't belong in a fruit salad."
Exactly. That's actually very good. That's actually very good. Exactly. These are because, you see, part of wisdom is also creating connections, and using imagination and using creativity, but creating connections in seemingly different parts of life, right? So it's one thing to talk about the categories, is it a fruit or is it not a fruit? And you're talking, when you say it doesn't belong there, you make a connection to another category. What I usually think when I eat fruit, I usually think, oh, dessert perhaps, or a form of a snack. I don't want to think of tomato as a form of a snack, right? That's a different category. That's a different category. Like, it's a category about eating. So we're making a connection between, let's say, the scientific category, which goes to part A, which goes to part B, and then we're talking about the, eating category, which goes under the snack category, which goes under the dessert category, or the main dish category. Or the side dish category, like, it's a different, like, type of thing. And I really like the way you put it. It's incredibly well phrased. But there you have it. So you folks, you can actually go into these bets, and you can see each person's position. If you want to dig into, there's also some comments, some better than others, I should probably say. And so let me ask you right off the bat, what did you think about, and again, you may hear some clicks because I'm going to be going through the website myself. We have some information over there. What did you think about, give me first impressions. You go there, and perhaps we can read some of the questions to people so that they can get an idea. And then you can tell me some of your first impressions, or we can start with your first impressions. Let's start with your first impressions, maybe.
Yeah. So when I first clicked on and started looking at it, like, we it's funny because myself and Duncan had talked about this, and we agreed off air about today's subject, and we thought, we're coming into the festive season, we'll keep it a little bit light, something a little bit lighthearted.
Right.
And Duncan sent me the link for this website. And I had a look at it, and straight away, first impression is, okay, this is not as lighthearted as we thought it was going to be. This looks particular. Even the phrasing on the questions, this is slightly more on the academic side. This is not somebody that you're going to meet down in your local casino making these bets.
Right.
This is well thought out. So that was obviously my first impression. So then I started digging into the questions. Like, so the first question that I dug into, and this is the last bet that's been made, it's like the most recent one.
Mm-hmm.
So by January 1st, 2037, Tesla will have been the first company with 1 million vehicles that are capable of SEA level 4 autonomy on over 90% of public roads in the contiguous United States, with human level safety or better. And this capability will be usable by the general public commercial.
Right.
So that's the broad spectrum of the bet. So the SEA, just for people that obviously probably might know, is the Society of Automobile Engineers, and they have laid out, I think it's up to 5 levels of, I suppose, safety levels, more or less what they are, restrictions. And level 4 is the second last. It's almost fully autonomous, but it's not quite. So that's basically what this bet has looked at. This was an interesting one. And this is by 2037. So that's 15 years away. We are about, if I'm not mistaken, probably. Am I right in saying that Waymo's, the Google car project, was the first autonomous car project, or was there something before that, Duncan?
Oh, I'm not. I'm certainly not a historian, but it's definitely like one of the first ones for sure. I'm sure somebody.
So that was 2009. They started in 2009, and they at the moment have level 4 cars operating in San Francisco and I believe Phoenix as taxis. Now, these cars are not commercially available. They're used as sort of robo-taxis, and they're only working in these 2 states. So they do have they are at level 4.
Right.
Tesla are at level 2, which it doesn't sound like a lot.
Oh, no,
actually is.
Well, it's funny. It's funny that you mentioned that, because you see, all of this is connected to the things that we were discussing last week, and actually connected a little bit to the rant I had earlier, right? Because when we're talking about speed, all bets are off, right? I mean, the way counting works in technology, it skips numbers, so to speak, right? I mean, that's the sort of like the exponential growth of things. So it could be like on level 1 for decades, and then spend a couple of months on level 2, and then the next week is on level 3, so to speak. And of course, I'm exaggerating a little bit, but that has happened. Like, things potentially move exponentially if we get into specific roadblocks. So that's absolutely, you're absolutely right. Level 2 is not as bad as it sounds.
No, it's like, I mean, level 2, for the listeners, level 2, the driver has to be in the driver's seat with control of the steering wheel. And there are a lot of features that are automated. There are features that are automated, but the driver always has to be sort of more or less in control. Like, you're not relinquishing control really at any point. And that's the basics. I believe Tesla, there's 2 or 3 different stages of their level 2, different packages that they offer with their cars. But the thing I found, I think the thing I found kind of most interesting about this bet was, and I was actually looking at it there just before we came on air, and it felt kind of flawed, because when I was looking at the SEA regulations, in order for these cars to operate on 90% of the roads, the cars would have to achieve level 5.
Level 5.
According to standards now.
Right.
That, like, based on the standards that are laid out now. The bet seems a little bit flawed. The phrasing maybe seems a little bit flawed, but that's
going to happen.
I'm not losing money on it. But it seems a little bit awkwardly worded, because they're gonna have to be at level 5, because it's under normal, like the terms of the bet are under normal driving conditions. So that could be anything from rain, sleet, and sort of moderate snow that you would encounter in different parts of the country. These are all major factors when it comes to autonomous vehicles.
Right, of course.
Because you're talking about sensors on cars, cameras on cars, all of these things which do not necessarily react well to adverse weather conditions. Level 4, the car will drive autonomously under level 4 but only when certain conditions are achieved. And other than that, it won't. So yeah, this is an interesting one
It's an
because
interesting one. What's your verdict? Like, which side would you go on? And again, I mean, the bet is roughly speaking by 2037. Tesla, in particular, will have more than, what was it, 4 million?
1 million
1 million,
vehicles.
1 million at level 4. Yes, 1 million.
Yeah, I don't doubt that Tesla will get there. I think it's possible. However, the way the bet is worded, and as a gambler, that's always going to
All
be
that matters. That's right.
all that matters. It's all about the wording and what's in there. No other if another company does this first, the bet,
Exactly.
that's it. You've lost the bet. Tesla didn't. So this is all contingent on Tesla getting there first. Now, the fact that there is a company out there who is operating already 2 levels above, and like we're not exactly like we're not talking about a mom and pop garage here. This
Right.
is like, I mean, this is huge.
That's right.
They can, realistically speaking, get there a lot quicker than Tesla can if the desire is there. And that's the other element of it.
That's
like
right.
You're actually relying on these companies taking that direction and wanting you to be able to drive in all these different conditions.
Right. So
whether that's the long-term goal or not, that's another thing.
That's another thing. So it sounds like you're leaning towards the no side of the bet.
Yeah, I just think for all these things to happen, I think it's too much. I think the biggest drawback for me is the 90% of public roads.
Yeah.
Because I think that there, even if they achieved everything else, I think the 90% of public roads is going to trip them up, because that's a pretty massive undertaking.
Right.
To have everything mapped out and stuff like that. And they maybe don't have the resources that, like, if a company like Waymo, if they partnered with, say, General Motors, who have much bigger fleets of cars on the road, will have much more data collection opportunities. They have really could get there a lot faster. Tesla doesn't have that. So that's a drawback for them in that situation.
I really like the way you're approaching this, because that's what I was hoping we would do. Like, we're going to go into the nitty gritty, how to dissect a bet and trying to find value in a place where there's not supposed to be value, you know?
Yeah.
So because that were my thoughts exactly. Like, I would, like, the moment I read something like this, remove the name Tesla from the bet, give 15 years. Honestly, like, 15 years is a lifetime for technology. Like, you know, we can potentially see this much earlier than that. You know, if we were to, I mean, I can't talk odds because I honestly have no idea, but like, I would almost certainly, with the name Tesla removed, I will definitely take the yes side there. Now, with Tesla in particular, I'm not even sure if Tesla is going to be solvent in 15 years. And I know people's like, what are you talking about? Because again, I mean, Tesla is not, and I'm going to get a lot of flack for this, right? I mean, it's not, I know it's going to, like, this is an incredibly...
Be careful, Duncan, you'll be removed from Twitter.
That's, I'm ready for it. Come on. You know, however you slice it, you know, if you know anything about, you know, the market capitalization of this company is a highly overpriced company. Now, whether or not is, you know, there is a good reason why it's being so overpriced, it can be debated. I mean, it brings things to the table, but it's not the only company specifically for autonomous vehicles. Now, for electric vehicles, yes, arguably it is the leading company, but companies come and go, and Tesla hasn't been around long enough to prove that it's a company that can remain solvent for prolonged periods of time. Like, being a company that survives for a long period of time is actually very, very difficult. So on the grounds of that alone, on the grounds of lack of longevity, we can't necessarily know, you know, if this is going to be a company that, you know, like Napster, you know, starts really well, you know, with MP3s, and then it disappears from the face of the earth. I mean, you know, if you're my age, you know, when you were growing up, Napster was the thing, you know, like of the internet. And now, I mean, young kids today don't even know what.
But changed the shape of how we deal and listen to music forever.
Good point. Exactly. So a lot of the things that people like Tesla for can still be there. Like, I mean, there's still going to be innovation, but whether or not it's going to be solvent in 15 years, that's it. Like anybody who's into businesses and knows how quickly businesses come and go, it's debatable whether or not they have an incredible moat around their company. And I know some people will say yes, they do. Some people will say no, they don't. I'm not arguing about that, but it's something that really makes me worried to see that name in there, right? It's a company that hasn't been around for that long.
Yeah, and it should be like, I mean, just to actually throw in on that, because there's actually another bet where I was looking into like Tesla's share price and market capitalization, and it should be kind of noted just based on what you're saying, that Tesla sales were up 58% this year.
Yeah.
They had sales growth of 58%. Their
Right.
share price is dropping through the floor.
That's right. That's right. Because again, I mean, if you
So
if you read their
that's worrying.
That's very worrying, because already, like if you do their market capitalization, I believe with some metrics, they have the market capitalization of all the other electrical vehicle companies combined, something like that, something ridiculous like that, and they definitely, even though they have like a good enough market share, they're not as big as the price suggests. So a lot of what happens in Tesla price is a huge anticipation far beyond what they currently have, and having potential and realizing that potential is two different things. And in a hyper competitive environment like the one we live, this is sort of dangerous. Of course, none of that is financial advice. You always do your own research on things. But personally, as a gambler, you're asking me, would you bet Tesla? Absolutely not. So beautiful. So speaking of controversial things, a Bitcoin, number 853, the Bitcoin will be worth less than $1,000 US by the end of 2025. That bet was created 2 years ago, and it's to last for 5 years. So a Bitcoin will be worth less than 1,000 US by the end of 2025. Go.
Yeah, this one was interesting. Like, a Bitcoin, in reality, a Bitcoin is worth nothing. Like, in real terms, a Bitcoin is worth nothing. It doesn't exist. It's backed by nothing. It's held, but the only thing that keeps it supported is the market around it.
That's right.
It could go to zero in the morning under the right conditions, which is always, is always going to be. We've seen massive price fluctuations in Bitcoin over the past 12 to 18 months. Right. Seems to have kind of steadied a little at the moment. It's still kind of holding in around that sort of 17, 18 mark. If I'm not sure I haven't checked it in a few days. Mm-hmm. 3 years time to go to it under 1,000. I'm not sure whether it drops that much. Some recent people I was listening to suggested that maybe we're kind of at a stage now where it's going to level off, and it may, you're talking minimal fluctuations, maybe up a few thousand, down a few thousand, but the huge swings may be gone out of it. Which, okay, I'm not heavily educated on the crypto market. I'm literally watching prices, kind of seeing the trends more or less. But I think it's possible.
Okay, so let's say in the spirit of Christmas, we place you under the gun and we ask you take a side. Which side would you pick?
If I was under the gun, I'm gonna say no, because I think there's enough more. Because the logical side of it, there is so much money out there invested in it. There are big players who are heavily invested, and it's in their interest to keep the price up. They can keep it up a certain amount. Obviously, they can't support the market, but yeah, I think like less than 1,000 is basically a collapse at this point, considering the highs we come from. So whether that will happen in 2 years or 3 years, I don't think so. A gun to my head, I'm going to say no.
Okay.
But long term, if you were to stretch that out over 20 years, I would say I would be on the yes.
I
long
like
term,
it.
but I don't see it.
Yes, I'm actually with you. Hopefully, we're gonna get into bets where we disagree, but a couple of points, because you made some very good points. First of all, the long-term point, like I'm on the record saying multiple times that cryptocurrency is here to stay. Not necessarily Bitcoin, but the thing that Bitcoin has in its favor is that already it has spread out, so it's decentralized, and getting those things decentralized is very difficult. So we have to be very careful with these kind of arguments, because creating the new Bitcoin is not going to be easy, because again, you have to a lot of people have to trust it. You have to spread it around so that people don't have more than 50% control of it, right? So it has to be decentralized. That being said, there is nothing that prevents us from creating something in the future that is potentially much more efficient, much smarter. Technology again doesn't have necessarily an end, right? And that's one thing. So I'm very much with you with that. You also mentioned that people saying maybe stabilizes and things like that. I just wanted to draw a little bit of a parallel, because you triggered that thought. It is Philosophical Friday after all. I see that happening a lot in the world of crypto in particular. And I would argue, with everything that happened with FTX, it is very common that people, and I don't know how else to phrase it, but very often people don't know what they're talking about. And what I mean by they don't know what they're talking about, myself included, by the way, what I mean by we don't know what we're talking about is that there is not enough information to possibly know what we're talking about. That's very similar to trying and ask a machine, how does human perceives reality? So how do markets perceive reality? We don't really understand that question. So for somebody to come and make prediction, people really think that they're making honest predictions. There's some crooks out there, right? I mentioned FTX. The person is under indictment. Who knows what he did, what they didn't do? I'm not saying either way, but there's some crooks out there, right? So, but the problem is, even people who mean well, we don't have enough information to actually make accurate predictions. So when people making predictions about the markets, they don't know what they're talking about. They can't know what they're talking about, right? That's the other thing. So we have no idea. Like, that's why we can never see those collapses coming. We did not see the market collapses coming of the real estate collapse. We didn't see the stock crash coming in the 2000s. And of course, people will say, well, there's some few voices who said, a collapse is coming. Yeah, these are the perpetual, as we call them, bears, like people who are always thinking the collapse is coming, right? If you go and you look at some of the people who predicted the collapses, these are people who are generally bearish, Taleb included. When Taleb wrote his book, the Black Swan, and then a year later the collapse happened, Taleb is worried about his risk his entire life. I am, in some sense, a perpetual bear. I'm always worried about risk, right? I'm always worried about risk. I say that to people, don't play, like nobody's rolled enough to play the main event, like unless you are like, a multimillionaire, like 10,000 is not something you can afford to risk, right? I am saying that all the time, but the point that I'm trying to say, to make here, is that we don't know when we're making those predictions, so we have absolutely no idea. So the way you said it's tough to tell, I think it shows that it's very difficult to make those predictions. That being said, I don't think again, worthless opinion, but I don't think the Bitcoin is going to drop below 1,000 by 2025, because price and value are two different things. Whether it's worth zero or not is irrelevant. I don't think people, unless they absolutely need the money, they're going to drop and run.
I agree with you. I definitely I definitely think you're right that this one is going to be this one is not going to be won by the person who put it up. It's I did have a thought there, and it just actually escaped me. It just completely went down in my head, but that's okay.
we love cats, it's it's
I did. I had a thought. It's something I wanted to say, and it just completely escaped me at the
So
end.
sorry. I thought you said okay. You thought okay. I misheard. I thought there was your cat was getting into the. Sorry. So
Oh
you
no,
had thought.
I put the cats out before we started recording. I couldn't. I have my headphones on, so I just about heard them screaming at the door, obviously looking for
Got it.
something. But we'll deal with that later.
Got it. So if Peter, at any point during the conversation, if that thought comes back, because usually sometimes they do, let me know, and we're gonna go back to this. Speaking of financial stuff, do you know what is the largest bet ever made on this website?
The largest bet.
Yes.
No, like I see one in front of me for I think both sides put up 5,000 each.
Mm-hmm.
That was 10,000. That was the largest one I came across.
Okay. So if you scroll down around the area of like 362, and by the way, numbers are being skipped because not all of these bets are public.
Oh wow. Okay.
Yeah. There is a bet for $1 million each adjusted for inflation. So it ended up settling for $1.1 million. This is a very famous bet. You may have heard of it if you are in the markets. That's actually how I found out about this website, because Buffett mentioned it in one of his shareholder meetings. And basically, this is the famous bet that he made in 2008. That was, after the big collapse. And he said that over a 10-year period, commencing in 2008, the S&P will outperform a portfolio of funds or hedge funds when performance is measured on a basis net of fees, costs, and expenses. So that's very important. So basically, it's market versus hedge funds. Who wins? After fees, that's very important, right? So he's saying, okay, so a passive investor that takes their money and they invest it in the simplest vehicle possible available to people. That's the S&P 500. For the listener who doesn't know, these are the 500 biggest companies. And, essentially it's an ETF, exchange trading fund. So you can actually put the money in there and sort of like take the averages of the market versus an actively the word escapes me right now. Actively managed. Excuse me. Yes, exactly. Actively traded or actively managed. Exactly. Fund from a hedge fund. Who's going to win? But you have to remove costs, fees, and expenses, which S&P is sort of like passive. You just pay a very small percentage. I believe it's 0.03% a year to Vanguard or something like that. Versus 1% a year, 2% a year, whatever like these hedge funds are charging, plus costs for like trading and things like that. Yes. So this.
No, go on.
No, please. What are your thoughts? I want to hear your thoughts.
I think that's really interesting. Like that, something so simple, like
very simple.
The simple investment model, with but again, remove all the administration, all the fees. You take out the glitz and the glamour of the hedge funds. You take that money out, and the simpler product is coming out ahead. That's it's really that's really interesting, especially when you consider how traders, look, we probably all watched Billions and stuff like that. You see these characters and making big trades and making billions and crushing their results, 10-15% returns and this kind of stuff. That's obviously not the reality of the actual hedge funds across the board.
Correct, exactly. And Buffett's argument is actually very simple. It says the average investor is going to perform average, right? So if you take all of the he makes a distinction. He makes a distinction which is similar to a distinction his teacher was actually making. And that distinction is between active investors and passive investors. So passive investors are the ones who basically don't do anything. They just go in the market, some form of an ETF. And then by definition, since they are just basically buying the entire market, at smaller proportions, of course, per stock, they're going to perform average. So that leaves the active investors. So if the passive investors perform average on average, then the active investors must also perform average on average, because the total average has to average out, right? So he says, okay, so out of all hedge funds, I mean, some of them are going to perform above average, some below average, but on average, they're going to perform average. So how do you find, like sort of like the active investor that you think is better than the other ones, especially in the face of what I would call unknown risk? We don't know exactly what kind of risk we're dealing with, right? It's not like poker where we know what we don't know. We don't know if the opponent has kings or aces, but they cannot have jokers. We know that they have specific holdings, in their hands. One of a variety of different holdings. Markets are not like that. With markets, we don't know the things that we're missing. So we don't know what we don't know. So it's funny because that bet actually was settled in 2017, and Buffett famously won by a landslide, by the way. And that was after financial collapse, where some of the hedge funds were saying, we can win in down terms and we can win in up terms and stuff like that. None of that stuff happened. So it was an interesting bet.
Which actually, if you sorry to cut across you, which is actually quite interesting, because you would imagine that a really smart active investor, like 2008, when we're at the bottom of everything, stocks are cheap,
right?
Companies are, there's a lot of value if you know where to look. If you're really that active in the markets, and you're doing there's value to be had. That was a perfect time to be getting in on, because the market was at bottom, and that's exactly when you should be putting your money in. Right. And it should realistically only, go up, especially if you're being, if you're active and you're identifying, a lot of stuff would have been undervalued at that point simply because everything collapsed. But that obviously didn't happen.
Right, that's a good point, exactly. Because again, it comes down to this is an incredibly good point, actually. It comes down to the discrepancy between pricing and value. Price and value are two different things. So just because the price goes down, it doesn't mean it cannot go lower. Tesla is a perfectly good example, right? I mean, Tesla dropped, double digits this year, high double digits this year, and it's still overpriced. And what I mean by it's still what I mean by overpriced, it means that it's not a good value. Based on what? Based on the actual profitability, based on how much money that company produces. Because once you start putting these, not in terms of how much is the stock worth, but in terms of buying a company, this is essentially the same stuff that Buffett says, right? I mean, I'm not reinventing the wheel. I'm not doing anything new. But if you go and you decide, you know what, I want to buy a business. I want to buy a new business. How much is this business producing every year? Let's say, to keep things simple, it produces $1 million. Okay, would you pay $1 billion for it? Would you pay no, but with Tesla, people are doing it. People are going and saying, you know what, I would do it because it's amazing. Who knows what it's going to produce in, X amount of years, right? So that kind of stuff.
They're buying into a dream more than they're actually buying into the fundamentals of the company.
Correct, exactly. And there were companies both at the collapse of 2000 and I'm not, by the way, saying that the PE of Tesla is 1,000 PE, but I was just exaggerating the example for the listener to get an idea, right? I do that a lot here, so feel free in the comments to bash me. I'm always ready for that. So, but the idea here is, again, that there's a difference between price and value. So when we are, for example, after the dot-com crash in the 2000s, when there were literally companies with 500 PE, so they dropped from 500 PE to 30 PE. It's price over earnings, right? That's still an incredible multiplier, especially for some specific industries. So a company drops tenfold, let's say, and it can still be expensive, which was part of the fear in the markets in 2008. But to your point, Peter, you're absolutely correct. There were companies where when you looked at the fundamentals, like especially companies like Microsoft is a perfect example of that. You start looking at Microsoft, and the price over earnings of Microsoft was like it reached, I believe at some point like 5 or 10, like I forget the exact numbers, but it was ridiculous. Like for a company that was growing that fast, and the earnings kept going up every year. So that is where value comes in, and that's where smart people like Warren Buffett come and pick up the pieces. So you're making a very, very good point, but there is also that difference between pricing and value, and people are always look at they're being results oriented, so to speak, because the price is the result, right? Is looking at your opponent's cards, but just because your opponent had aces this time and you had kings, it doesn't mean you misplayed your hand. And conversely, just because like you won with 7 deuce, it doesn't mean you need to be playing this hand. That's exactly the difference between price and value. Sometimes the price can be tricky, can be tricking you into thinking that something you should keep doing this because you bought something very expensive and went further up, or you're thinking, oh, I'm a good stock picker, or you sell a company which was really bad sell because it was really good value for you, but you sold it and then it went even lower. So you thought to yourself, great, I'm a good stock picker, I know when to get out. But in actuality, it's far more complicated than that.
Yeah, and I think a really good example of that, and probably a lot of our listeners, especially any poker players, like heavily into crypto and the NFT space, and that's an area where a lot of people just sort of plunged in at huge prices simply because they just, this is just going up and up, the values. This isn't, this is great. This is easy money, and how much money do people lose buying it? Like the smart people got out at the sort of the peak of the market. They could kind of see that the overall value of the thing wasn't really there.
Right. The smart people never got in.
Yeah, smart people never got in. Like, a complete, like, what I think we'll look back on in a few years and sort of generously referred to as an absolute fad that cost people billions.
Yeah, and again, I mean, if we've been through. I mean, we're not. We're not that old. I mean, like I'm probably older than you, Peter. I mean, I'm almost 40, but we still have seen some
I wish you were older than me, Duncan. I'm 45.
Oh, you don't look it. Congratulations, sir. Congratulations.
Thank you very much.
Very nice. So, but we have seen already, in our short lives, we have seen already those collapses, and they happen. You're talking about fads. Fads happen all the time, and they will happen again in the future. People absolutely love those fads. But I like it that there's, like those voices of reason, like Warren Buffett, we will remind us, that we're not as, smart as we think we are. We may be smart at an individual level, but not when it comes to things which are bigger than us, like the markets. Like a certain humility, and certainly meta humility, is perhaps required to be able to navigate with that.
And it almost comes back to if you take it in poker terms, the simpler strategy is off, and the more consistent strategy is often far better than the fancy play syndrome that an awful lot of people suffer for in poker. And the same invested. Like if you look at Buffett and what they invest in, like their biggest growth in the last year, Berkshire Hathaway, has been in oil.
That's right.
Simple,
simple,
straightforward, very old, but it makes money.
That's right. It does make money. That's exactly right. And Buffett is very good at doing that, and Munger, Charlie Munger too, like, and his team, like, I mean, they're very simple, like, they still own Coca-Cola, right? From 70 years ago or whatever it was, like they still own that company. It's not something that they bought for like the next 5 years even, or certainly not the next month, right? I mean, they still own Coca-Cola, and it's just amazing. And you reminded me of something. You reminded me of that simplicity, like not FPSing. You reminded me of something. I don't know, just to lighten the mood a little bit. I don't know if you're following Hustler Casino Live. recently, but they had this very aggressive player. His name is Hans, who was in the show a few months ago, and I don't know if you saw that, but he basically, to make a long story short, he had ace king before the flop. That was 6 or 7 months ago, or maybe more than that by now, I forget. And there were close to, I want to say, 800 to 1,000 big blinds deep. And there was
that sounds about right for Hustler Casino.
Right, exactly. And there was a player to his immediate left who was on a winner's tilt, right? I mean, he was winning a lot, and he was playing like very tight. And to make a long story short, I think it was like a button versus small blind dynamic. But honestly, it really doesn't matter. It could have been cutoff versus button, but it really doesn't matter. The moral of the story is, all the money got in, for 800 big blinds before the flop. And I'm like, it doesn't matter if your opponent shows you 7 deuce. How could you get all the money in with ace king? And that's the thing, we're talking
I actually do remember that. I actually do remember this hand now. I can remember it now, actually, as you said it. Yeah, that's like, it's just way, way too much to be investing.
Right. I mean, so what if you're the opponent's, like, I would go as far as saying, if you really have trouble with concepts like this, just, it's okay to always fold, so to speak, ace king to, let's say, a 4-bet. What's the worst that can happen? Like, if let's say we're folding ace king to a 4-bet every single time, let's say. I'm not saying we should do that, but let's for the sake of the conversation, go there, because we're trying to create a heuristic that can help us simplify the noise. What's the worst that can happen? Do we really expect to make money from spots which are going to be close anyway? Like, is that like, I mean, as poker players, we make money from situations where opponent is weak, both in terms of strategy, but also in terms of the specific spot, right? When somebody 4-bets, by definition, they're not weak. So we're not going to make a ton of money anyway. So are we really going to try to be that person who's going to get like that extra 1% of EV or like 2% of EV? Just like, honestly, like folding the ace king before the flop to a 4-bet every time, which, by the way, like, somebody's going to hear it, it sounds like ridiculous. Like, that heuristic is so much better than try to navigate when is the correct time to get 800 big blinds in before the flop.
Like, I think it's funny, because this is something that comes up in our coaching groups,
Right.
quite a lot. And, sort of players will ask a lot of some of the higher stake guys, at what point, like, what's the cutoff point for getting it all in with ace king? Like, what are we talking? Is it 170? Is
That's
it
right.
180? Where do we draw the line with wanting to get it all in? That's online.
That's right.
Where players are, loose, more aggressive. There's a lot more 3 and 4-bet live 800 big blinds.
That's right.
Aces, and that's it. I'm not getting kings in.
That's exactly my point. You shouldn't.
No,
you shouldn't.
No,
you shouldn't.
It's a losing bet. I can guarantee it. It's a losing bet.
And here's also, I agree with you 100%. Here's the punchline. Even if kings is not a losing bet to get it in, it's not that much of a winning bet to begin with. So you're not sacrificing much. That's the key point. The key point is, it's not thick, fat value there that you're getting like the kings versus like the entire range of deuces through queens or anything like that. Not even close. Like, if we're lucky, sometimes, our opponent has, like queens or something like that, if we're lucky, when we're talking about that deep. But it's probably not worth it over the times. But that's not the fun part of the story. The funny part of the story is, I mean, he won that session because he's very aggressive. His post-flop play, I can stand by. He's very hyper aggressive, and I like the hyper aggressive style because I'm also hyper aggressive. I like that idea. But then again, I mean, the metaphor that I like to give, it's like a boxer. You go into the boxing room ready to punch everybody. You think you're stronger than everybody, and then occasionally somebody punches back, but very rarely, right? Because most people don't know how to punch back. So you punch everybody, they're bleeding, and occasionally you are in a fight where somebody's ready to punch you and they're strong and they're confident, and you say, you know what? I'm going to fight another day. Bye-bye now. So you're ready there, you're punching everybody, And then sometimes somebody shows strength and you're like, look, I'm gonna quietly walk out the stage right now. I'll let you guys fight it out, and then I'm gonna punch the next guy. So that's sort of like the metaphor of hyperaggression. Like if you don't know when to get out, like that hyperaggression is gonna bite you in the rare end.
You'll just run into it. Sometimes you have to know when to pull that back.
Exactly, absolutely. But the interesting part of the story is that fast forward 6 to 8 months later, and he does it again, and he bumps into aces again, and he does it again with ace queen suited. He loses again. So he did it like 2 or 3 times. I mean, obviously the cards like run unfavorably, clearly, but the point is, why? Right? I mean, why? And I get a lot of flack sometimes that people saying, well, Duncan, I mean, some of the things that you're saying are very simple, right? I mean, to the point that potentially somebody may argue they're too simple. And of course, there's a lot of nuance, and I'm happy to get into the conversation. You know, is it 100 big blinds that we should get the ace king? Is it 170? But in the end of the day, if you are like losing so much by making errors, we're talking about 800 big blinds deep. Honestly, it doesn't matter. Just draw your own cutoff. Just randomly throw darts on the wall and draw your own draw the cutoff at 80 big blinds. It really doesn't matter. You know, it really doesn't matter. Like you're going to save so much money by keeping it simple there.
Yeah. And it's like that. It's risk versus reward. But there's another factor there as well. It's especially if you're a good player who's probably got a bit of an edge on most of it. You're winning in the game. Is the opportunity cost you lose out on if you bust and you have to walk away from that game.
That's
by taking it all on a
opportunity cost. Yes.
On a 51-49 split. Yes. Where like if you're winning 50 and 20 big blinds, you know, per 100 at that table, why would you ever take a flip for your money?
That's so beautifully put. You know, Peter, you know what I'm sitting here and thinking, you should have co-authored that book with me, because it's seriously, no, I mean, seriously, exactly that opportunity cost. There is a passage there in the book that I'm describing the same thing. There's 2 players, you know, as well, Alex and Bobby. So Bobby is being splashy. He doesn't do the crazy stuff, getting all the money in before the flop, but you know, he loses $20 here, $50 there. He calls with like 7-3 suited, because who knows, maybe he gets lucky. Of course, he misses the flop, blah, 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 blah. So by the end of the session, you know, Bob is like down to like 50% of his initial stack. You know, Alex, she's not catching anything. She lost like, let's say, about 10% of her initial stack, right? Because again, she a few C bets that didn't go her way. She defended here. That's about it. Played like, let's say, a couple of hands in the next 2 hours. Bobby has been playing, you know, almost all of his hands. Now, here's what happens. They both get dealt the same hands. Let's say this is a thought experiment. But towards the end of the night, they both get the magical hand. They get the aces, or they flop their set, or they do. But here's what's going to happen. They're both going to double up. So Bobby's going to go from 50% to 100% where he started. And Alex is going to go from 90% to 180%.
Yes.
That's exactly the opportunity cost you described.
Yeah.
Exactly the opportunity cost you described.
Missed opportunity because you just splashed around, you know, and made silly, poor decisions that's cost you. And now it's really cost you, because the big opportunity has arisen to make serious money, and you're not there. And like, even to relay that back to investing, if you're going to be investing in silly stocks or silly projects here and there that may or may not go anywhere, when you do finally get an opportunity to invest in something that's really solid and literally goes to the moon, if your flow that you can put in there is a lot smaller, your return's going to be a lot smaller.
That's correct.
You may have cost yourself serious money there.
That's right. Exactly. And an opportunity cost, incidentally, people like Warren Buffett and Charlie Munger, they talk about it the most, right? I mean, this is like the saying, you know, and they say that's the thing that they care about. I mean, number one rule is, of course, to not lose the money for their investors, because they also running a public traded company. But then right up there is opportunity cost. They have all of these options available to them. So every time they decide to go with one company, the question is, what could I have done instead? And are there better alternatives? Excuse me. So they're incredibly picky with the way
Yes.
they do investments. And it's, yeah, I mean, I'm really happy we actually got there, because again, that concept has been a lot of my mind. Maybe we can do, and maybe the listeners can let us know too, an episode on fancy playing syndrome and what are some, simple heuristics, to avoid issues like that, because it is the reason why I think is very relevant. And you brought it up, Peter, and you're absolutely correct. I mean, thank you for reminding me. That's such a wonderful topic. Like, you see talented players like Hans, right? People who are like, you can tell, I mean, people who have studied the game, they understand aggression, they understand the spots, they understand ranges, right? And at least post flop, they've probably done some work perhaps with some solvers, and yet something that simple, it escapes them, because they're thinking in terms of some calculated, overly calculated, overly complicated formula that says, well, I mean, when the game is that aggressive and your opponent's range is that wide, you should never fold ace king because it has at least 43% against the entire, like, what are you talking about? Like, that's not how people play. Yeah. Right? Sometimes we just have to, eliminate that noise, right? And we can say, it reminds me of the gambler who's going to say, oh, you know what, I'm sitting down at the roulette table right now, and I've seen red coming 10 times in a row. It's still 50-50 because every roll of the ball is independent of the other. But you have evidence, perhaps, if anything, that 10 reds in a row came, right? If you were a proper scientist, at least you would ask yourself, maybe there's something wrong with that roulette and red comes more frequently, right? At least you would have asked it. Now, if you reject that theory, it's a different story. But to just be that person who's like, oh, I'm going to say what the math says, and I'm not going to escape from that specific rigid formula there, So that's how I sound in my sleep. So.
only when you're at the roulette table.
No, I mean, this has been a rant. So it's been the episode of rants for me today. It turns out it's a really pet peeve of mine, Peter, because I think simplicity is such a elusive part in poker games, and it's something that people look down upon. Right, it's not as complex, and you see how people are reacting to strategy. They want to know all about GTO. They want to know all about the complex strategies. But how can you get to those complex strategies? And that's what I always tell my students, like, you really want to take a really high level math class, like, let's say, measure theory. You want to take, like, have you understood calculus really at a deeper level? Have you taken like linear algebra, like basic math classes? And it's difficult to go to the next level without having the fundamentals down, I feel.
Yes. And you can't. You're absolutely, like, I mean, the fundamentals are key in all walks. I don't think it matters anything you're doing in life. If you do not have the fundamentals, you cannot move to that next level with any sort of proficiency. Now, you can try it, but it'll be hit and miss, and you won't have any sustained success at it. But if you build, it's like building a house. You build a foundation first. If the foundation is strong, the house will be solid. If the foundation is shaky, that house ain't lasting. It's going to come down at some point.
That's a good point. Yeah, no, that's absolutely a good point. And we need to keep that in mind, sort of moving forward. So maybe, an episode on the fundamentals. That's one of my favorite topics when it comes to poker and poker strategies. So excellent. Do you have any final thoughts? I know we talked a lot about a lot of things, but this is Philosophical Friday, so.
Yeah, we certainly went on a couple of tangents, but I think they're all pretty interesting and
my fault.
topics. Listen, that's okay. I think for the listeners, people should definitely I think people should definitely check out the website,
Yes.
longbets.org. It's definitely worth the look,
Hmm.
just to see some of the debates that people are actually having, because it did spark interest for me in, things about like that, about the autonomous driving, and there's a couple of other subjects there. When you
Right.
start looking at it and you go, maybe that's not as clear cut as I thought it was, and you can
Yeah.
delve a little deeper, and it's a kind of a thought provoker, and it's definitely worth a read. But yeah, it's I think another thing, it's definitely prompted me to be always looking for positive EV bets.
Great.
And like, if anything, if for especially for poker players that are listening, this is the kind of thing when your coach tells you don't place a negative EV bet. These are the kind of things they're talking about,
Right. Right.
because there's just no value. There's no value in these. Like, I spent several hours today going over some, looking at both sides. Obviously, I'm not an expert in it,
Right.
but both sides are so convincing
Very
for
convincing. Right.
every single, like. There's a couple that are a bit more, look, why did somebody even bother taking the other side? This is almost done already.
Right.
But the likes of the Tesla one, yeah, they're just, it's on a balance. It's a balancing act between all the different elements, and there's just no value. It's, as you said, it's more about creating awareness about around the topics, and sort of generating conversation and debate. And when those things happen, that can move things on.
Absolutely.
That can move things on to the next level.
Absolutely. And humans were notoriously terrible at making predictions. That's one of our weaknesses. We're not meant for that. Like, our physiology, our biology is meant to deal with short-term threats. That's why we have
Yeah,
like good reflexes for the most part. That's why we have like those spikes in adrenaline when something happens. So we're very good at dealing with the immediate danger. We don't know what it means to plan for the future. So this is something that we have to externally train ourselves so that we can fit ourselves to the current environment, which is more long-termish, so to speak. There was no such thing as long-term until about, that concept of long-term practically for human beings. And again, a historian is going to be, or a sociologist, I guess, they're going to be more accurate about this, but it's no more than about like 100 years ago or something like that, when basically the birth rates started to, I meant to say the childhood fatalities started to stabilize to low digits. Like, a lot of kids were dying, like about 100 years or so ago. So it
yeah.
wasn't
The infant mortality rate sort of
infant
dropped way
mortality rate.
down.
That's the term.
Yeah,
Thank you, Peter. Yes, exactly.
yeah,
The infant mortality rate stabilized. So there were less, fluctuations there. So people didn't even know. I mean, mothers also died during birth, right? They didn't even know if they would
yeah.
survive the birth. So it was like a sort of like a short-termish uh, mentality. I remember a friend of mine who's a historian. He told me part of the reason why they decided to put a retirement at the end of 60 is because nobody would make it to 60 to collect those retirement checks. I didn't know that, and that sort of like
That's
makes sense.
interesting.
That's pretty interesting, right? And it turns out that part of the reason, that now we have all of these issues with backlogs in terms of like social security here in the US, but in other places too, is because a lot of people live longer. So that concept of long term, it's not in our DNA. We don't get it. So we're very terrible with making predictions, and it means we actually have to work externally to be able to navigate those things, and we don't even know how to do that either. So it's very hard.
No, we're novices at that at this stage.
Very,
Like, it's just trying to
very.
get a poker player to deal with variance is hard enough. But we can't see past that 5 buy-in downswing. Never mind the, sort
Right.
of a long drawn out 200,000 hand sample. So
Good point. Good point. Downswings is a perfect example of us not
yeah,
understanding the concept of long term, right? I mean, we with Brad, we've talked about this, the concept of proximity principle, right? I mean, that we're always looking at what happens to us short term. Like, we cannot step out and see
yeah,
the graph is going up. 5 5 buy-ins down, saying, oh my goodness, that's going to put a huge dent in my 10,000 buy-ins upswing that I have long term. Those 5, they're going to kill me. But that's how we react. We're human. We're completely human.
Yeah.
So
I've had negative days in my graph and it's looked awful. And when I've looked at year to date, it hasn't even, it's not even a blip. It doesn't even look like it changed.
Exactly.
It was so small.
So small,
like,
right?
You really have to zoom out on things like that.
Yeah. Yes, but we can't, and that is a real. Yes. When I say we can't, I should be very careful. We can't instinctively. We have to work on it. It's not. Yeah. It's not, and we have to take it seriously. I'm one of the people who say a tilting is real. We can't, like. I don't like advice that goes like, "Oh, don't tilt." There's no such thing as don't tilt. Manage to how to not do that. Like, find a process that works for you, and that can be a lifetime process, right? It's not just don't do that or do this. Like, we're not good at following instructions, right? I mean, we have to find a process that allows us to be able to do this desired instruction, right? We can't or the desired outcome, if you will, that instruction implies. We can't just randomly somebody tell us do this or do that and we can do it. No, we're not wired like that.
No. Because if we knew, like, I mean, and I think most people do understand, especially with something like tilt, saying don't tilt. But I think most people know that they shouldn't be tilting in the first place. And if it was as simple as just telling yourself, well, don't do this, they'd have done it already. Like, exactly. I mean, it doesn't even make sense just to say, well, don't do that. Well, obviously I don't want to do it, but like, I need a process. I need to learn. I need to educate myself more on why this is happening, what to do, and how to handle it, how to manage it. And that's what it is. It's about managing it.
Yeah. So just become a neuroscientist and, like, you know, turn off your lizard brain, like like a magician. Yeah, that's a lot of fun stuff. Maybe we should at some point do a conversation on that stuff. But yeah, feel free to let us know in the comments. Peter, where can people find us? I know you are on the Village all the time, so where people can find us?
People can find me in Greatness Village. You can get the link to Greatness Village to Tracing Poker, greatness.com. I'm there, say hello. You'll also find me on Twitter, just Peter Birmingham, Twitter. You'll see the CPG logo on my picture. I'm very, very recognizable. So yeah, you can see me there. Semi-active on Twitter. I try not to rant too much on Twitter because I tend to get myself in trouble when I rant too much on Twitter. So.
I know, I know, me too. And as a reminder, again, these are some of our thoughts. It's not the end all be all. There's no person who is the end all be all. Just some thoughts. And we're trying to be as honest as we can with things that we're saying. So. Peter, I don't know. Like, I think you're doing a phenomenal job. So if anybody,
thanks very much, Duncan, I appreciate that.
So if anybody has any, you know, objections, you know, like I address them to me, you know, like that's. I think Peter is doing a phenomenal job. So I'm the one who's running on the tangents, and especially today, I ranted a couple of times on some of the topics. So, but it's, you know, we're human beings. We're, you know, it's that's how it goes. Sometimes we just have to speak our minds. We can't self-censor ourselves. You know, that's going to be difficult.
No, and I often think the best conversation or the best ideas come from the conversations are, you know, that just flow when you just let it flow and you get to. And to be in fairness, how many times did we circle back around to the same point? You know, even though you went off on a tangent, it still circled back around. So it was all relative if you look at it. If we take the overview, we won't take the short term sight of the rant in the middle. We'll take the overview of the whole episode.
Very good, Peter. I agree. Like, that's exactly right. Exactly how I feel. Like, there's all of these connections, and this is I remember, like, you know, studying when I was a kid. I mean, we have a lot of access, as you can imagine. I mean, I grew up in Greece, so we have a lot of access to some of our, you know, ancient, so to speak. And one of the things that it's apparent from reading those texts is that, you know, philosophers on different topics, like philosophers that talk about, like, let's say, ontology, they're not really philosophers of ontology, right? I mean, philosophers, like, which, by the way, the word literally means the friend of wisdom. It doesn't mean some, genius guru or anything like that. Anybody who cares about wisdom, like you alluded to earlier, is a philosopher. So in that loose term, we're all philosophers. When we all of us, wisdom lovers, so to speak. But the point was, it doesn't stop with a specific domain. It's not all about ontology and we're never going to talk about morality, for example, or it's not all about morality, we're never going to talk about medicine. That's another thing too. Hippocrates would actually talk to other philosophers about other topics. So then we would talk about math, they would talk about the cosmos, all of that stuff. It is all related. It is all related.
You can't separate it. It's just, you cannot separate. You can talk about them in a vacuum and like pinpoint certain, but you, as a whole, if you really want to delve into a subject, you're gonna have to bring it. It's gonna move into different areas, different subject matter.
Correct. Exactly. And so, some of those
connections. Nature of life.
In your life, exactly. Correct. No, very good. And some of these, I was about to say, some of these connections may seem weird, unfair at first, maybe even unwarranted, but that's why we're here for, to discuss, and see, illustrate a point, dig deeper, and trigger some thought. That's all we can do.
Exactly, and hopefully we've triggered a few thoughts for the listeners this week.
Absolutely. And well, I think we're going to have another episode before the end of the year, so we're not going to send our wishes just yet, but well, thank you everybody for tuning in. Peter, once again, thank you for being here, for being an excellent co-host, and I guess we'll see everybody next week.
Yeah, thanks very much, Duncan, and we'll see you all next week.
Absolutely.
Take care, folks.
Take care, everybody.